Right now, the market is handing quality investors something we haven't seen in 30 years. High quality businesses. Companies growing earnings more than 22% a year are getting cheaper, not more expensive. Their stock prices are falling while their cash flows rise. That gap between price and value is the widest it's been since just before the dot-com bubble burst. And for patient investors, that gap is where generational wealth gets built. Stay with me for the next 9 minutes. I'm going to show you exactly why this disconnect exists, three specific companies sitting at the center of it, and how to think about acting on it, using the same test Peter Lynch made famous. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here's what we're covering today. First, the problem: why the market is punishing quality stocks right now. Second, the real cost of following the crowd during a panic. And third, three companies from a compounding quality where earnings are rising and prices are falling, plus the one mental test that tells you when to buy more. As of mid-February 2026, Mr. Market has turned aggressively negative toward the most resilient stocks on the planet, companies in the top tier of their industries. The quality factor, which crushed every other style from 1981 to 2021, is being treated like damaged goods. $100 in quality stocks in 1981 grew to roughly $11,300 by 2021. Value got to $4,500. Growth hit about $4,100. The World Index? $3,400. Quality wasn't close. It was in a different category. And yet, right now, Mr. Market is pricing these businesses as if their futures have been permanently broken. They haven't. The fundamentals are intact. Earnings are growing. Cash flow is rising. What's compressed is the multiple the market is willing to pay. Here's the number that tells the whole story. Over the past 5 years in a compounding qualities portfolio, owners' earnings grew an average of 22.3% per year. Valuations dropped an average of 10% per year. The businesses got stronger. The prices got weaker. That's a cumulative 33% discount on companies that are performing better than ever. Sentiment is a lagging indicator. Market prices reflect yesterday's fear. A quality company's true worth is set by tomorrow's cash flow. When the crowd flees based on current volatility, they hand disciplined investors world-class businesses at fire sale prices. So what's driving the sell-off? One word: AI. The market has convinced itself that artificial intelligence will replace existing software, wipe out accounting firms, and make specialty insurance obsolete. The iShares software sector ETF dropped over 25% in 6 months. Quality names got dragged down with everything else. Jensen Huang, the CEO of NVIDIA, the company that builds the chips powering AI, said publicly that investors are exaggerating AI's threat to software. His view: AI operates inside existing programs. It makes software better, not obsolete. I was working with a client recently who called in a panic. He owned a position in a specialty software company that had dropped 30% in 2 months. Earnings were up. Revenue was up. Customer retention was above 95%. Nothing about the business had changed, only the headlines. We walked through the numbers together. He kept his position. That's what discipline looks like in real time. The crowd sells quality stocks because they read a headline. Then they watch from the sideline while those same stocks recover. That pattern has repeated after every panic since 1987. The cost of following the crowd is permanent. You sell low, buy back high, and lose the compounding years in between. Quick pause here. If you're getting value from this breakdown, do me a favor and hit subscribe. Most of our viewers aren't subscribed yet, and the algorithm uses that signal to decide whether more investors see this kind of analysis. We also have a companion video on how we identify quality companies before they show up in the headlines. I'll link it at the end. For now, let's get into the three specific opportunities. Our investment philosophy rests on three pillars. Buy high-quality companies, ensure they're led by excellent managers, and acquire them at fair valuations. Right now, all three pillars are aligned in a way we rarely see. Let me walk you through three founder-led companies, one from our portfolio and two from our bullpen of high-conviction positions from the Compounding Quality Stock Letter. Link in the description. Number 1. Bullpen Stock, Constellation Software. CSU is the world's premier serial acquirer of vertical market software companies. Since its IPO in 2006, it became a 100-bagger in 15 years, compounding at roughly 28% per year. It owns thousands of specialized software businesses in niches like healthcare and public safety, where switching costs are extreme and reliability isn't optional. The market is selling CSU because of AI fears. But vertical market software requires 100% uptime. AI serves as a productivity tool inside these platforms, a smart helper, not a replacement. The stock trades at 16 times free cash flow. For a business of this caliber, that price hasn't existed in years. Compounding Qualities shows CSU is trading at a roughly 119% discount to intrinsic value, with an expected annual return of 14.4%. Number 2 bullpen stock, Kelly Partners Group. KPG is an owner-operator-led serial acquirer of accounting firms in Australia. Brett Kelly, the founder, owns over 46% of the company. That alignment matters. Since its IPO, KPG has grown over 19% per year, doubling investor capital every 3.75 years. The stock dropped nearly 50% in 6 months. The reason? AI will supposedly replace accountants. Meanwhile, KPG built a 51-49 joint venture to deploy AI tools across its firms. Management says they're overwhelmed with opportunity for acquisitions and would be buying back shares with a great deal of enthusiasm if they weren't allocating capital to new firm acquisitions. Compounding Quality's model has KPG at a 95% discount to intrinsic value, with an expected return of 15.3%. We reviewed the earnings, the acquisition pipeline, and Brett Kelly's track record. Compounding Quality is adding to its position. The price was the only thing that had changed. Number 3. Our value-aligned portfolio stock, Kinsale Capital. Kinsale is a specialty insurance underwriter, and the closest comparison is Geico in its early stages. Berkshire Hathaway's investment in Geico returned 100 times its money. Kinsale is gaining market share in a segment growing faster than the broader insurance market. Last year, the stock fell 15%. Earnings per share grew 15%. That's a 30% relative cheapening in 12 months. Mike Kehoe leads the business with a long-term target of 10 to 20% annual growth. Their underwriting and technology advantages are widening the gap between Kinsale and the competition. Compounding Quality's model shows a 69% discount to intrinsic value, with an expected return of 14.6%. Peter Lynch put it plainly, if a stock is down but the fundamentals are positive, you should buy more of it. That's the test. One sentence. Apply it to every position. Is the stock down? Yes. Are earnings growing? Yes. Is the management team aligned with shareholders? Yes. Is the business model intact? Yes. Then the price drop is an invitation, not a warning. Buying quality means three things right now. Prioritize companies that maintain strong margins and market share, regardless of broader sentiment. Recognize that a lower price on a growing business is a reason to add, not exit. And focus on the business's ability to reinvest capital at high rates. That's what compounds wealth over 10, 20, 30 years. A lower entry price doesn't just give you a margin of safety, it increases your yield on cost for decades. You're starting a compounding engine from a baseline that may not come back for another generation. If you got value from this breakdown, you're going to want the companion video where I walk through exactly how we screen for quality companies before they show up in the headlines. The three buckets framework we use to build every position in the portfolio. That's right here.